RateScope here. We've talked about how COMEX works. We've gone through the vault numbers, the registered versus eligible game, the daily drain, and the delivery data. So now the big question is, what happens next? If COMEX is a fractional reserve silver bank with falling inventory and rising delivery demand, where does this go? Today I'm going to walk you through 3 realistic scenarios for what comes next, and then translate each one into the investment risks you need to understand. By the end of this video, you should be able to answer, for yourself, which path you think is most likely, how much risk you're actually taking in silver and silver-related assets, and what kind of position sizing and time frame makes sense for you. This is education, not financial advice. Always do your own due diligence. Quick recap: why we're even asking what happens next. Just to set the stage, here's why this question matters right now. Registered COMEX silver, the metal available for delivery, is down around 70% from 2020 levels, roughly from 300 M plus ounces to about 103 M. Daily outflows from the vaults have spiked, roughly 785,000 ounces per day walking out on average. In January 2026 alone, 50 million ounces left COMEX vaults, versus only 6 to 7 million in the whole of 2024. February 2026, which isn't even a main silver delivery month, has seen delivery rates near 98% and more than 18 million ounces delivered already. March open interest has been in the 400 to 500 million ounce range, several times the size of registered inventory. The first notice day for March is February 27th, when we find out how many of those futures longs actually want metal, not just paper. So the system is clearly under stress. Not guaranteed collapse, but not everything's normal either. With that in mind, let's talk about 3 scenarios. COMEX uses its rulebook: cash settlements, margin hikes, trading limits. Paper and physical silver decouple further. They kick the can again, but physical fundamentals tighten even more. Then we'll map those into your risk buckets: leverage, counterparty, concentration, and time frame. Scenario 1. COMEX flexes its rulebook: cash and control. In the first scenario, too many people ask for metal, and COMEX decides to protect the system the way exchanges have done in the past, by using the tools buried in its own rulebook. Tools like cash settlement instead of metal, raising margins to flush out participants, position limits and liquidation-only orders, even contract redesign over time. Let's break those down quickly. A. Cash settlement. If registered inventory looks stretched, the exchange or individual clearing members can approach large longs and say, instead of giving you silver, we'll give you cash plus a small premium. If that doesn't get enough people to back off, they can force cash settlement under certain conditions. This is written into many exchange rulebooks under emergency powers or force majeure language. On the surface, no default. Everyone gets paid. But in reality, anyone who wanted metal has just learned that their paper claim turns into dollars when it matters most. Confidence in COMEX as a physical price setter is damaged. Industrial users, sovereigns, and serious investors will remember that and adjust their long-term strategies. Maybe not instantly, but over time. B. Margin hikes and trading limits. We've already seen margin hikes this cycle, and we have the historical playbook. 1980, Silver Rule 7 introduced liquidation-only trading, crushing the Hunt brothers. 2011, COMEX hiked silver margins 5 times in 2 weeks, helping cut a bull run almost in half. If COMEX sees too much pressure, they can raise initial and maintenance margin requirements again. That forces leveraged longs to liquidate, either by choice or through broker margin calls. Futures price can collapse quickly, temporarily relieving delivery pressure by destroying speculative demand. They can also impose or tighten position limits, restrict some accounts to liquidation only, make it more expensive in capital terms to hold large long positions through delivery. From your standpoint as an investor or trader, you do not control these dials. You can wake up with a drastically different margin environment and be forced to sell at the worst possible time. C. Contract redesign. Longer term, the exchange could shift more volume into cash-settled contracts that have no delivery right, reduce the relative importance of traditional physically deliverable contracts, gradually steer participants toward financialized silver exposure only. That preserves the trading machine but turns COMEX more into a silver price derivative casino than a true metal exchange. Scenario 2. Paper versus physical divergence widens. Scenario 2 is less dramatic in the short term but very important structurally. COMEX keeps functioning, but the gap between paper and physical realities grows. We're already seeing early signs. Shanghai and other hubs quoting higher physical prices than COMEX. Some wholesale dealers reporting backlogs and delays for large orders. Silver lease rates rising to many times normal levels, indicating it's harder and more expensive to borrow physical silver. In this scenario, COMEX continues to trade on macro headlines, Fed expectations, the dollar index, and algo flows. The screen price can still be slammed up or down quickly, but if you want to move real tonnage, 5 million, 10 million, 50 million ounces, the number that matters becomes, what does it cost to actually get this much metal delivered on schedule? That number might be COMEX price plus a big premium, or completely unanchored from COMEX if supply is tight or constrained by export rules. For large users, mints, refiners, solar producers, chip fabs, grid infrastructure projects, they might start negotiating direct long-term contracts with miners at prices that reflect true scarcity, not just COMEX moves. For you, as a retail investor, SLV, futures, and other paper products might show one picture. Physical coins and bars, especially in size, might live in a different world with higher prices, limited availability, or both. This doesn't make exchanges irrelevant. It just means the benchmark they produce isn't the full truth anymore. Physical metrics, premiums, lead times, lease rates, become at least as important as the COMEX chart. Scenario 3. Can kicking plus tighter fundamentals. The third scenario is probably the most boring and the most likely in the short and medium term. COMEX survives March. The system doesn't blow up on a single date, but the underlying issues do not go away. What might that look like? March deliveries are heavy but not catastrophic. Eligible silver is reclassified as registered at the margin. Some longs accept cash premiums instead of bars. Margins are raised at key moments to curb hype. Price whipsaws, but the exchange stands. At the end of it, headlines calm down. Silver is still trading. COMEX still publishes its daily inventory report. But ask yourself, what really changed on the fundamentals? The world still has a multi-year silver supply deficit, on the order of 200 million ounces per year for several years. Cumulative shortfall since 2021 is around 1 billion ounces. Industrial demand from solar, EVs, electronics, and AI infrastructure still trends up, not down. 80 to 85% of silver production still comes as a byproduct of other metals, copper, lead, zinc, which respond to different economics. Bringing a new primary silver mine online still takes years, not months. In that scenario, COMEX has successfully kicked the can, but the pressure in the pipe increases. Inventories remain tight. More people wake up to the structural deficit story. Each subsequent delivery cycle has less slack to play with. That tends to end not with a single explosion, but with a repricing event. Silver moves to a new range where demand cools off enough, or supply is incentivized enough, or both. Exactly when and how that happens, nobody knows. But the system then has a new equilibrium, until the next structural shock. Now translate this into investment risk. Knowing the scenarios is useful, but the real value is understanding how your own risk profile interacts with them. Let's break this into 4 main risk categories: leverage risk, counterparty risk, concentration risk, time frame risk. 1. Leverage risk, futures, options, and margin. If you're trading silver futures, CFDs, options, or highly margined miners, you're exposed to sudden margin hikes, forced liquidations you don't control, overnight gaps triggered by rule changes or news out of CME Fed geopolitics. In a Scenario 1 environment, cash settlement and rule changes, leveraged traders are the most vulnerable. If margins are doubled overnight, you might not have the cash to maintain positions. You can get blowtorched out at the bottom even if your long-term thesis is right. Risk management answer: only risk a small percentage of total capital per futures position. Assume 30 to 40% adverse moves can happen fast. Don't build positions you can't hold if CME moves the goalposts. 2. Counterparty risk, paper products versus physical. Paper silver includes ETFs, SLV, etc., unallocated pool accounts, structured products, futures and options linked to COMEX. In Scenario 1 and Scenario 2, You could see cash settlement instead of metal. You could see tracking errors between ETF price and real physical market prices. You could see changes in redemption rules, borrowing programs, and lending policies. Holding at least some portion of your silver physically, coins and bars you directly control or in truly allocated storage, is how you reduce dependence on counterparties. Reduce your exposure to rule changes that favor the house. Paper tools can still be useful, just don't confuse them with metal. 3. Concentration risk. How much is too much? Now look at your overall portfolio. Ask, what percentage of your total net worth is in silver, silver miners, silver ETFs, and related products? If silver experiences a 30 to 40% drawdown in a short period, which history tells us is absolutely possible, what does that do to your overall financial position? Example, total capital, $100,000, 10% in silver related, $10,000, 40% drop, $4,000 loss, 4% of your total net worth. 30% in silver related, $30,000, 40% drop, $12,000 loss, 12% of your total net worth. That 12% hit is the kind of thing that makes people panic, causes them to sell at the worst possible time, or pushes them into taking even more risk to get it back, which usually ends badly. Understanding your maximum pain point is part of being a grown-up investor. 4. Time frame risk. Trader versus stacker identity crisis. Silver is a strange asset. It has monetary properties like gold. It has industrial demand like a base metal. It trades like a high beta, sentiment-driven macro vehicle, and it's heavily influenced by leveraged paper markets. If you say, I'm a long-term stacker, but you behave like a short-term trader emotionally, or you size like a hedge fund using leverage, you're taking time frame risk. You have to decide, am I holding silver as a multi-year position based on structural deficits and monetary hedging, or am I trying to trade it over days and weeks around COMEX behavior? Different answers require different position sizes, different tools, physical versus paper, different mental and emotional expectations. Mapping scenarios to investor types. Let's connect the dots. If you're a long-term physical stacker. Scenario 1, cash settlement and rule changes, mostly affects futures players, ETF holders, people relying on COMEX to always be fair. For you, the bigger question is, does a COMEX credibility hit lead to real repricing of physical silver over time? Scenario 2, paper-physical divergence, is actually where your edge emerges. Paper price can stay low or choppy. Physical metal shows its true scarcity through premiums and availability. You benefit by already owning ounces. Scenario 3, can kicking, requires patience. No blow off top, no instant moonshot. Just a background of tighter deficits and less inventory. You accumulate when fear is high and headlines are ugly. If you're a tactical trader, Scenario 1 is where you can get killed by margin and rule changes. Scenario 2 means your paper trades might not map cleanly to the physical story. Scenario 3 can still be great for trading. Volatility plus clear fundamental direction equals opportunity, but only if you stay disciplined on size and risk. If you're a hybrid, hold a core of physical silver that you largely ignore on a day-to-day basis. Use a much smaller tactical allocation in miners ETFs, futures around that core. Let COMEX drama influence your trading decisions, not your sanity. Final thoughts. Your job isn't to predict the date. The mistake I see over and over is people trying to pick an exact date when COMEX will die, silver will explode, or some binary event will happen. Markets rarely follow our script that neatly. Your job is not to predict the exact timing of stress. Your job is to understand how the system works. Recognize when stress is increasing or decreasing. Size your exposure so you can survive volatility and stay in the game. Match your positions to your time frame and risk tolerance. Silver is one of the most emotionally charged markets in the world. That's why the only real edge you can have is clarity about structure, clarity about risk, and clarity about yourself. If this helped you see the next phase of the COMEX silver story more clearly, hit like, subscribe to RateScope, and tell me in the comments, which scenario do you personally think is most likely over the next 12 months, and how are you positioned for it? This is education, not financial advice. Always do your own research and know your own numbers. Invest with logic, not hype. RateScope out.